Here to help guide us through the highs and lows of the gold market, the CEO of McAlvany Financial Group, David McAlvany. David, we sure appreciate your time today here on America's Forum.
Thank you, sir. Good to be with you again.
Now, it's the risk of dealing with a politically incorrect joke, but I just have to fess up to you, David. When I served in Congress, I had a senior member say, we were on the Ways and Means Committee, he said, you always see, or you never see a one-armed economist coming in because they always say, on the other hand. So get ready for one of those on the other hand moments. Here it comes, David. There are reports that say the price of gold is rising and now is the time to invest. But on the other hand, some other reports say gold is headed lower. Can you explain the conflicting reports and which side do you tend to come down on?
Sure. Well, most basically, there's a difference between analysts who see a massive amount of deflation coming and those who see a massive amount of inflation coming. And the belief is that gold does very well during inflations and not very well during deflations. Contrary to that, 600 years of British and American history, every major deflationary period, gold did quite well. Gold did quite well. A minimum increase in purchasing power of 45% during the 1930s. The most recent catastrophic deflation, gold improved your purchasing power by 245%. So I think that it's a misnomer and a misunderstanding of the role of gold as money, where these analysts assume that deflation is going to be the death knell for gold. Has never been in 600 years of British and American history. They've got a lot of proving. And I think on the inflationary side, you do see investors look for a way of covering risk, of hedging against an inflationary outcome. And investor demand for gold tends to go up when the fear or the expectation of inflation changes. And I think that is what we have in front of us. We've got the central banks of the world who've been printing like mad to bring us a new normal. And this is not the Fed only, this is the Bank of Japan, this is the Bank of England, this is the European Central Bank, all playing by the same rule book, so to say. And I think what we have now is a tremendous amount of inflation embedded in our economy.
So David, with that in mind, what can we expect in the following months? Like, how should we plan ahead for the future? What would be your recommendation?
Sure. I think someone looking at the gold market, you could still see a good 5 or 10% downswing, but I think you're looking at gold, which is set for a 100% move. I think seeing it trade to $2,500, $3,000 an ounce over the next 3 years is not out of the realm of possibility. That is, from these levels, what does that indicate? That indicates to us a radical shift in inflationary expectations. And I think it's coming. You look at MIT, the folks at MIT obviously are pretty decent at putting together numbers. They started a project a number of years back called the Billion Prices Project. The Billion Prices Project is a way of trying to track household inflation, what the average Joe and Susie lunchbox out there experience as inflation, not the PCE, which the Bureau of Labor Statistics prefers, not the CPI, the Consumer Price Index. Both of those numbers tend to be fairly massaged. The Billion Prices Project comes up with an inflation number today of around 3.91%, just shy of 4%. That's double the official rate of inflation. If that's the case, and we have closer to 4% inflation, you realize that the last GDP report, instead of being just a little bit negative, would have been for the first quarter negative 5.62%. So again, these inflation numbers are very critical in terms of how we create a feeling in the marketplace. And certainly it behooves those both in Washington and on Wall Street to get the consumer back out there and spending without regard for ongoing concerns in the economy. So to understate inflation is to overstate GDP. To understate inflation is to try to get the consumer to get out and spend with greater confidence. And I think, in fact, what we'll have in the second half of this year, you should say, in 2015, is a radical increase in the expectation of inflation. We don't have to see a radical increase in inflation for consumer behavior to change and for the gold and silver market to take off handily. Well, I would suggest to you that over the next 18 months, we've got silver trading at $30 to $35 an ounce, and gold, it first has to get above $1,500, then you've got $2,000, $2,100, with $2,500 being realistic in an 18 to 24 month time frame.
David, you talked about the anticipation of inflation and really the psychological effects. I'm interested in black gold, Texas tea, oil. We take a look at this, and energy prices in general. That's just not a feeling of inflation. When those prices go up, what do you think is going to happen internationally, given the situation in Iraq and in the Ukraine? What kind of price hikes do you think we'll see hitting us in the pocketbook for energy costs?
Sure. Well, and I think this is one of the critical things that people are aware of when you go back 14 years to the beginning of the new century. The year 2000, we had oil closer to $20 a barrel, and now it's resting close to 100. To assume that there's no cost inflation, there's no the consumer doesn't experience a head of lettuce or a loaf of bread, anything that they buy at the grocery store. Listen, it's impacted by the oil price. So your basic needs, filling up the tank with gas, filling up your grocery cart, the things that most people, other than housing, spend the majority of their money on, it's gone up in price considerably.
Right. And in fact, we're looking at, you're talking about gas, we're talking about oil. In fact, AAA is saying that summer gas prices are the highest that we've actually seen in 6 years. Do you attribute that to what's going on in Iraq?
Sure. I think there's some pressure there. I mean, keep in mind, it could get a lot worse because we have some cushion. We price our gas needs based on supply here in the United States. And obviously our economy is much more sensitive to, at this point, because we've grown some of our production capacity, much more sensitive to the TI or West Texas Intermediate contract than it is Brent crude. Brent has been the main contract which has increased with the pressures in Iraq. So, and frankly, for not that many good reasons. We've compromised maybe 500,000 barrels of oil per day, and out of OPEC production of 30 million barrels of oil per day, you're talking about a very marginal impact.
And David, we will have to leave it there, my friend. We thank you so much for your insights on gold and oil, all that important stuff. We look forward to having you back. Don't you go away. America's Forum continues after this time out.